Hi, my name's Ryan Frost. I'm a financial advisor here at Harrison Brook, and today we're going to be going through the Harrison Brook Selected Model Portfolio range. And to assist us in that, we've invited Nick Skelhorn from Corrival Capital in to really just give us an overview of our portfolios and ask a series of questions. Nick, to start off with, just so our watchers and listeners could understand how the portfolios work, could you just give a bit of background about yourself and the portfolios?
Yeah, absolutely. Well, thanks for the opportunity to be with you, Ryan. So I'm a director of Corrival Capital Management. We provide investment management solutions to clients and advisors based in the UK and offshore. Our offshore service is predominantly aimed at custom-built advisor-branded model portfolios where the advisor has input and can make sure that they dovetail in with their own proposition, and that's what we have successfully launched with yourselves. In terms of background, I'm quite old, Ryan. I started my career in 1993 as a trainee stockbroker, we were called then. I worked for large firms. I led a smaller team that was then sold to a larger sort of discretionary fund management house. The early part of my career was probably focused more on solutions for private clients and trustees, whereas for the last 10 years, it's been dedicated to working, predominantly with professional advisors. So I think I've got a pretty good grounding in the various aspects of the investment management industry as it's evolved over that sort of 28-year period.
Thanks. That's great, Nick. One of the key questions that we've been getting a lot from our clients is, obviously, we've seen quite a lot of volatility in the markets of late, and most are looking at where the markets are potentially going to go for the rest of 2021 and where you may think they're going to go in 2022. Could you just give a bit of an overview of what you're expecting to occur in the coming months and into the new year?
Absolutely. Well, it's always good to get the easy ones out of the way first. So thanks for that. I think the quickest answer is obviously we don't know. A more intuitive answer would be gains are obviously going to be harder to come by than they have been over the last few years, and certainly over what feels like the last 12 months. Markets look tired towards the end of the summer, so it seems like we're entering a period of or tentative sign of them correcting lower. Seasonally, the second half of September and October have been quite tricky for stock markets. So we wouldn't be surprised if they fall over the next couple of months, trying to find a level where buyers are enticed back into the market and forming a new trading range. In terms of sort of expectations, there's a lot of uncertainty around. I suppose you could say there always is, but there seems to be more at the moment. So factors we're considering would include COVID. What's happening to inflation, what's going to happen to the central bank support that's been put in place over the last 18 months, not to mention the sort of ongoing trade spats that seem to be kicking around, and obviously some fairly important elections. So if we looked at it and how we position portfolios for COVID, if we get potentially a vaccine resistant strain, that's going to change the market leadership again. So in other words, what stocks and sectors do well and which ones don't. So we've got a healthy balance in the portfolios in both camps until the picture clears. In terms of inflation, is it transitory or not? Do we get a longer transition period? More sticky inflation for longer is going to create disruption for bond markets, but that in turn could spill over into which areas of the equity market or stock market do quite well. And we've also obviously got the valuation of stock markets. Some parts of the market look more expensive than others. We've got to have a healthy exposure to both, so we're always buying value, hoping that we can participate when other investors' capital gets deployed there. So it's time will tell if we're right. We know we've got some challenging periods coming up, but we seem pretty well spread and diversified to tiptoe through what's coming, we think.
Sure. Great. Obviously, one of those key considerations when you're building those portfolios is probably risk. And I know we've set up several different risk grades, but could you just give an overview of what a risk graded portfolio is?
Yeah, sure. So a risk-graded portfolio is a collection of different asset types and investments that are designed to offer an attractive return for the risk that a client would want. The underlying mix of those assets and investments changes with each risk profile. So perhaps the easiest way to illustrate it would be to look at the both extremes, so low risk or high risk. So if we look at low risk portfolios, that's effectively where you're going to have a lower allocation to risk assets, so typically to stock markets, and a higher allocation to assets that have historically given you provided less volatile returns, giving a bit of ballast to help smooth out the peaks and troughs in the portfolio. So I suppose, to summarize, a bit of a less exciting roller coaster ride. If you go to the other extreme, where you've got the high risk portfolio, they're almost exclusively invested in stock markets. They've got less ballast assets, less assets to smooth out the returns, and therefore you get higher peaks, higher troughs, or lower troughs, giving you a more volatile and more adventurous roller coaster ride. And so the key to take away with the portfolio is the construction, the sort of components underlying each pot changes as you move up the risk profile. Lower risk has less risk, higher risk has more risk.
Yeah, exactly, because often clients may have been selecting investment funds themselves over the last few years, and they could have took a very narrow approach to that and just say selected certain equity funds as an example. Do you see what benefits they can get from using a model portfolio like this over, say, picking funds themselves? Is it really come down to the fact that they are really spreading their risk and much more than really self-selecting funds, which may be very narrow?
I think so, yeah. I mean, I think if you've got somebody who specializes in investment management and that's all that they do, you're going to benefit and hopefully leverage off their expertise and experience in putting the portfolio together and picking investments that combine harmoniously to deliver whatever objective that portfolio is designed to do. So that would include areas of the portfolio which, let's look at stock market. So allocation to large, medium and smaller companies, allocation to different types of industrial sectors, which changes from, potentially from year to year. The key benefit also is that you're when you have discretionary permission, which is how we manage your portfolios, it's really simple for us to rebalance portfolios across all clients that are linked to one risk-graded portfolio in one go, which is difficult to achieve if you've got lots of different portfolios that have been picked by different individuals. So I think that and I would say this, but I think that the proposition that we've put together of harmonizing discretionary portfolios with advisor input to meet their client objective is quite a happy medium between the two options.
Exactly. And in terms of assets that you actually invest in, I know we touched on equities and kind of bonds and debt for lower risk portfolios, but what type of assets do you invest in overall? Okay,
so a diversified mix of traditional investments. You've covered government bonds, corporate bonds. We invest in UK and international stock markets. And we also include alternative assets, which again is quite important down the lower end of the risk profile. So alternative not being a particularly helpful description, but these would include commercial property when we use real estate investment trusts, exposure to a diversified list of commodities, infrastructure, so long-term global infrastructure projects, but also renewable energy producers, energy storage. The key thing for us is that we can trade in these investments on a daily basis. So we only use regulated collective investments, which should give us that daily liquidity on an ongoing basis, even in the most extreme market conditions. We get exposure through different types of vehicles. So in your portfolios, you'll see that with investment trusts, exchange traded funds, together with more traditional funds, and we use a blend of active management styles where they try and beat a particular index, or passive investment styles where they simply track an investment, a benchmark or index as well.
Sure. And in terms of rebalancing, how often does that typically take place in our portfolios? And would it need to be more actively done if we were in a downward market than, say, a positive market?
Absolutely. So it's an important part of the sort of risk management of the portfolio. So rebalancing effectively returns the portfolio back to its original or its amended exposures. So our approach is hopefully fairly common sense. We choose to rebalance in March and September on a routine basis. But should we get the opportunity outside of that routine scheduling to rebalance because of markets moving significantly, typically downwards, I would add, then we can implement a market-driven rebalancing, which we're alert to do. We have to keep in mind how efficient it's going to be. So usually you do need quite a short, sharp movement, but we're well equipped to implement that on a proactive basis when required.
Sure. And I think that feeds into my final question as well, is obviously markets have been very choppy over the last few weeks. Obviously, we've seen markets rebound a little bit today, but there's certainly been some sell-offs. How does the HB selected portfolios protect against the downward market trend, which we may be seeing over the next few months?
So I think this comes back to the diversification of the asset types that are included within the portfolio mix. You'll have seen that over the course of the last few weeks, some of the risk assets will have fallen in value, but the allocation to the other types, typically bonds and some of the alternatives, will have been unaffected. The level of exposure to the different asset types obviously varies with the risk profile, but even within the risk allocations, you'll have seen different performance from different global markets or different type of companies. So it really goes back to this underlying exposure and making sure that we've got ballast in lower risk portfolios to cushion the effect of falling stock markets, but also within the stock market exposure, having an allocation to different types of companies that should perform differently even when markets sell off.
Yeah, and I think obviously diversification is key there, and really that's probably going to be achieved more in these portfolios than someone probably selecting funds themselves.
Well, I think we always try to find the holy grail of uncorrelated returns, which is where if one asset rises, another asset falls at the same time. But that's getting harder and harder to achieve. That's where we're using our sort of experience and skill to find some newer markets which still offer that liquidity and risk profile that's pertinent for each portfolio that we can include to make up for example, the changes that we're not going to see from other traditional assets such as bonds, which typically cushion equity market falls. So we're having to almost expand the toolbox a bit, use different types of assets in order to achieve the same outcome. But we think that's a healthy, progressive attitude that your portfolios should experience.
Great. Well, thanks very much, Nick. That was really useful information. And thanks for taking the time to explain everything to everybody and our listeners. Obviously, I think the key thing is we're going to be putting more of these videos out. Obviously, if you do have any questions or you'd want more information, feel free to subscribe to our YouTube channel, or you can inquire on our website through the Get Started page, or you can also online chat with any of our team straight away by clicking the button in the top bottom right of our website. But thanks very much for your time, and we'll speak.